I got this morning. I'm submitting a deal for a client, and they're getting a really good rate at a credit union. Fairly well-known one. Can't say who it is right now, but they said, "Hey, we've unfortunately shut down due to the pandemic. We can't let you submit the deal."
Hold up.
First and foremost, lots of things that have been changing the last, as I was saying, 72 hours. A bit about our agenda before we get to questions. There'll be some brief introductions on my end. And of course, Michael, who can't be here today, he's working on a bunch of crazy, interesting mortgages from the last little bit, as you guys will soon find out. It's a very interesting time to be in the mortgage industry, either actually on the supply side or, of course, looking for a mortgage. The big thing you've probably seen in the news is rate fluctuations. There's been a lot of them. The stress test was announced to be changed a month ago. Now it's changed again due to these circumstances. So I'll give you guys a bit of the down low on exactly what that means. We'll talk really briefly about banks versus non-banks, because as some of you may have heard, some banks don't let you visit them in person anymore. So what are you going to do? So there's, I think, going to be an interesting discussion there. Look, a lot of people I know are, not to be taken lightly, but there's definitely, a bit of a crisis right now with people's financial situations. And there are some strategies to, I guess, weather the storm, which I will dig more into as we go. And then, as I said at the end, for those who are happily renting right now, what's a way to perhaps, level up the actual status quo of renting? And we've got a guest appearance by our partners at Key Living, Russell, who I'll let him introduce himself once we get to a slide. And then, of course, my favorite part is the Q&A. So yeah, quickly of the introductions, you can see our very serious, arms crossed mugshot here of Michael and myself. In a nutshell, for Michael, really quick, he's a partner of mine. We share the same, I guess, mortgage family. He's done, over 1,000 mortgages, definitely a mentor of mine. He is a total stud, as you can see, and he's worked on all kinds of mortgages, and he runs Lendrix Financial. With Level Up Mortgages, as a lot of you guys know on this call, it's been a kind of a new initiative for me the last year. I've been serving customers and helping people save money and helping people be really strategic, and I guess you could say level up in their living and their finances the last decade. Running a marketing company, being creative with just budget, and learning ways to spend money properly. So I'm very much of the strategic mindset, and I'm also very big in educating. As you can see, I think it's all about giving value and building, genuine relationships. And when they can be in the flesh, the more the merrier. But I guess for now, we're gonna, stick to the remote thing. So anyways, very excited to, walk you guys through some of the things we're learning firsthand in the market. Again, a bit about the company that I guess we're a part of, or I guess the brokerage that we've actually processed deals through. It's called Tango Financial, not to be confused with, of course, my marketing agency called Tango Financial. They do $10 billion a year of mortgages. There's 500 agents across the nation. And we work with 48 plus lenders, a lot of them being non-bank lenders, which is not the same thing as a private or alternative lender, which we'll talk about later. People that are giving you just the best rates on the market. A lot of people now are looking at alternative financing, though, because it's harder to qualify based off your income. So yes, there are some pretty good solutions there. And end of the day, it comes down to bottom line rates and really good solutions that help you, build your empire as far as getting more doors or more properties and making sure your income is qualifying in the best way so you can maximize your affordability. The whole thing is just how does this whole mortgage world integrate to what you're all about? So hopefully through today, you'll get some ideas in your head, things to, of course, follow up on with either your peers or myself. And it's an exciting time to be looking at mortgages. So jumping into things, let's talk about the rate fluctuation. So there's a lot of, I guess, numbers here. Focus at the very top here. Right now on a fixed rate, I'm seeing as low as 2.24. I want you to note these are all rates with different kinds of lenders, and none of them are actual banks. None of them are the big banks. Now, real quick around, and you'll see that it's actually decreased from 2.24. It was 2.49 just literally 2 weeks ago. So rates have actually dropped. In fact, I saw them drop below 2%. but they've recently been going up, and I'll talk about that in a second. So just the main things to glean here is that rates are pretty low. The big thing is that if you're putting less than 20% down on your mortgage, that means that is an insured mortgage, right? So that means that a CMHC, and there's two other, mortgage default insurers in Canada, they will guarantee to the mortgage lender that if you default, they will cover it. Which means that if I am a lender, either a bank or a non-bank lender, I can afford to lower the rate as much as I want within reason, because I have that security. As you put more and more down payment, it becomes a little bit fuzzier on whether there's actual insurance backed into your default insurance. It's actually backed into your mortgage, and that's where rates have to be a little bit higher. But you'll see a trend that the more down payment you have, the more you de-risk the property. And generally speaking, that means the rate's also going to go down. This is all on fixed rate, by the way. And again, fixed rate is really just influenced by the bond yield, right? So as bonds drop, I guess mortgages are a different asset class that's it's almost just as safe as a government treasury bond, but they're a little bit riskier. So they share the same risk curve. So anyways, as they go down, you know that fixed rates are going to go down. And that's been happening recently. Variable rates, does anyone here have a variable rate? Of course, if there's any homeowners, of course, anyone have a variable rate that they're working on? Because if you do, you're seeing rates as low as 1.95. That's because, of course, you guys have been hearing about the overnight rate going down, right? Which of course affects prime rates, and it affects the variable rate. So you can see if you have a variable mortgage, times are great right now. Just the quick stats on variable versus fixed. 75% of Canadians do fixed. Why is that? Well, it's just less volatility, and you can lock that in for a longer time. So yeah, there's just a bit of the rate climate just to consider. And of course, you can lock down a rate for up to 4 months now. Okay, so if you are looking to get a place in the next little while, maybe not tomorrow, you can lock in a rate. So definitely talk to your respective mortgage broker about that. And this is a great time to lock in a rate. If there are any
Sorry,
questions
Paul,
so
just a
far,
quick question.
Yeah, jump in.
How do you go from, so if let's say you weren't variable right now, because it makes a lot of sense to do that, do you have the option of locking it in fixed at any time?
Yeah, so usually you are allowed to go from variable to a fix. You can transition that, and then you can extend it, right?
Any downfalls to that, or anything to be cautious about when doing that?
Well, I mean, some lenders, if you got like a really cheap mortgage product and they have a whole bunch of fine print around like restrictions, or they've got a collateral sort of charge on it where like they'll charge you a huge penalty if you do it, be aware of that. But generally speaking, you can go from variable to fixed, from what I know, fairly easily. And but you can't really go from fixed to variable. So that's an advantage of being in variable. So yeah, I mean, it's a good time to think about that. And, obviously, I'm happy to talk offline about some options on where that might make sense.
Thank you.
Yeah, awesome question. So yeah, if you guys want to speak up, I mean, hell, it's way easier than doing it in the chat. We got a small enough group. So yeah, please do pipe up if you guys have any questions. Any questions more on the rates before I get into the stress test? Okay, so I'll proceed. So again, a bit of mortgage 101, but I think it'll be useful just to get a refresher on this. The biggest thing with qualifying for a mortgage, at least with a prime lender, because remember, not everyone uses a stress test on you. It's generally, people that are federally regulated. And believe it or not, some credit unions do not have to follow the stress test, but most other lenders do. So it's all about debt to income. So just a quick example here, there's the TDS and the GDS ratios, which means slightly different things. One's just around your total mortgage debt, or what would be mortgage debt divided by your income, versus your total recurring debt, which is, they say it's PIF. So it's your mortgage, your insurance, your heating, etc. So basically just think of it as like there's two ratios where they really are dependent on how much you make, which is the denominator. Let's say you're making $5,000 a month. And let's say your total mortgage cost and your other fees are $2,200. So basically it cannot go over 44%. So if you get laid off or your hours are reduced in the next little while, which God forbid doesn't happen, then if your income goes down, any lower than it at 5,000, suddenly your of course the percentage, assuming your expenses stay the same, that'll shoot up, and a lot of lenders will not allow you to go over 44. That being said, there are certain lenders that if you go with private lending, yep. Is there a question? I know I'm going fast, but there are ways to extend that 44% to 50 or 60 with certain lenders. But generally speaking, for a prime lender on your total debt servicing, it has to be 44% or less. So where does the stress test come in, right? So for current homeowners, you may know that there is now a stress test where they basically add 2% to your contract rate, or they look at what's a benchmark, which was 5.19 48 hours ago, and now they reduce it to 5.04. So in the last slide, I talked about one of the rates being 2.24, right? If you have an insured mortgage. So if you have 2.24, when we look at what your expenses would be on a monthly basis for your mortgage, that 2.24 based off used against your mortgage size would go into this formula. However, they want to add a bit of a buffer. If rates were to increase by 2% or you had some hardship, if rates were, again, let's say, 4.24, could you still make your ratios work? That's kind of what they ask. However, of course, being the government, they'll take the higher of both ratios, whether it's 5.04 or your contract rate. So if the rate was obviously 3.05 or greater, they'll take that plus 2%. So the higher of 5.04 or your contract rate plus 2%, that's how they qualify you off these ratios. So basically, what's happened is they changed the mortgage stress test benchmark rate to what was 2% on top of the average bank rate in Canada, which they somehow figured out. And every Wednesday they're going to have like an update. And basically it was 4.89 was the benchmark rate if you looked at what the average rate was across all the banks in Canada. They've scrapped that for now. All it simply is that it's 5.04. Used to be 5.19. What's the increase if you go from 5.19 to 5.04? Well, if you had a $500,000 mortgage and that was the most you could afford based off these ratios, you can now afford $506,000, which is a whopping 1.3% increase, which obviously isn't a ton, but it is a step in the right direction. And hopefully they'll soon activate the old stress test that was supposed to come in April 6th, what was about 489. Hopefully that'll come back again and we can start to afford a little bit more. So the 500,000 would turn to 525,000 you could afford with the old stress test that got deferred. I know lots of things going on, but that's a bit about the stress test that you've been hearing about, how it works and how it has evolved in the last 40 to 72 hours. With that, are there any questions people want to ask either on the chat or, of course, locally? And I know you're all muted, so remember to unmute yourself. Okay, seems good so far. Cool. Straightforward. So next slide. I got this morning. I'm submitting a deal for a client and they're getting a really good rate at a credit union. Fairly well-known one, can't say who it is right now, but they said, hey, we've unfortunately shut down due to the pandemic. We can't let you submit the deal, which for me was pretty shocking because you would think a lot of the lenders would be making a lot of money now, but a lot of lenders are starting to get scared that because of the mass layoffs, people are not going to be able to pay their mortgage payments, which again, I will soon cover how there's relief efforts for that. But basically, some lenders are starting to put things on hold. So yeah, like now is a good time to like really explore what's the right lender that I can work with that is going to shut their doors for the next little while and that I can actually hold a rate with. So, I mean, yeah, I was going to lead into now kind of the bank versus the non-bank lenders. And basically, yeah, a lot of banks right now, I've had clients say, hey, I can't go to the bank. They're literally closed and they're not going to do the remote thing. What do I do? And that's why they're coming to mobile mortgage agents to get some help. And I think beyond, people, being forced to talk to a mortgage broker, the big thing of a mortgage broker, and usually just, in other words, working with a non-bank lender, there's 4 points here. A lot of you, I think, will probably know this. There's a big article that was in the Huffington Post last year. how big banks are known to overcharge on rates, at least if you're looking for insured mortgages with smaller down payments. They just have higher rates because they know they can, generally speaking. And if the rates do go down, they're usually the ones that are kind of slowest to do that. That's in general, right? So basically, again, just things to know about. Yes, you can try your bank, but also they usually have higher rates. And the biggest thing too is penalties. So those who have mortgages now, not sure if you've read the fine print around if you were to cancel your mortgage, or sorry, break it rather, because you need to refinance, right, to have more liquidity in paying off debt, or maybe just having emergency cash. That counts as breaking your mortgage. Divorces count as breaking your mortgage. There's a lot of things that count as breaking your mortgage. So that's, I think 75% of people break their mortgage. And I think generally speaking, it's something we'll talk about more in the actual physical seminar. Generally, you can lose about $7,000 worth of penalties for like the average bank, which is, I think it's about 3 to 4% of your total mortgage. They will count that as a penalty. Non-bank lenders, which again, these are, by the way, called monoline lenders. They're people you might maybe never heard about. MCAP, First National, XMC. There's all these kind of like, all they do is mortgages, but they can charge a lower rate because they're so specialized on mortgages. They don't have the brick and mortar to worry about. And guess what? They get invested in by the bigger banks. They're kind of like a mini startup, but they're super legit. They've got tons of funding, but they're not as well known as the banks. So they can charge a lower rate because it's more competitive in that way. And they know a lot of people are risk averse and aren't going to go to them, which is why they can charge less. So anyways, keep in mind, there's a lot of great non-bank lenders that you've probably never heard about that work exclusively with mortgage brokers, and they give them usually volume discounts. And of course, some of them don't even open their doors up for people that are just coming off the street. You got to go through a broker because they want to see qualified clients that have gotten pre-approved, for example. So anyways, again, like real quick, there's less selection at a bank than, working with a broker, obviously. And the big thing is just around like bigger penalties. And also people lose deposits sometimes, right? So there's a thing around grandfathered rules on pre-construction. So if anyone here put down a series of deposits for a pre-construction in Toronto or Vancouver, wherever else you're tuning in from, and now it comes down to like, shit hits the fan, excuse my French, and you need to get a mortgage which you can't qualify for based off the benchmark and the stress test, you're kind of in trouble. You can lose anywhere from $10,000 to $40,000, deposits, right? So there are grandfather rules that before the stress test was first implemented in November of 2016, if you did, if you were, I guess, starting your deposits before then, you can get grandfather where there isn't a benchmark rate, and therefore you can afford a lot more, right? So those are all things to keep in mind that banks are a lot stricter on, and some of these more progressive lenders, they're definitely, I think, better at that, and they're more flexible. So for those of you who own a home, and I know there's definitely a few of you here, I've gotten a lot of questions about refinancing. So again, refinancing meaning you can switch lenders, get one of the record low rates on the market right now, and you can actually pull money against your property. So you can pull out equity to have for a rainy day, or some people are looking at getting cheap properties now and using that towards a down payment. It's up to you. But basically, it's a great time to look at a refinance, which again gets you a lower rate. Hopefully, the penalty is limited. And sometimes you'll see that actually it makes sense to get a penalty and maybe pay $4,000, but then in the next 5 years, you can see that based off the lower rate today versus what you got 5 years ago or 4 years ago, like the math could still make sense. So even if you do have to break your mortgage and there's a penalty, just do the math. Ask me for that. It's simple math, but we can use it for calculators. And just, I think it'll start making a lot of sense. But yeah, refinances for now, like we're talking about weathering the storm, right? So if you think there might be a layoff, if you think there's some, unforeseen expenses you'll have to do, refinances are fantastic. And the big rule here is that you can't ever have more than 80% of your equity out in leverage, right? So if you own 30% of your home right now, you can pull out 10%, right? To put you up to, 80% that's been loaned out. So you always have to have 20% down, 20% equity rather. You can never loan over 80%. So keep that in mind, but now's a great time to get a better rate, have cash on hand for a rainy day, and it's really cheap debt. And especially if you have big credit card debt, a lot of people reconsolidate their debt by pulling out, something that you're paying 2.24% interest on, and then paying off a 20% credit card, right? It's kind of like an arbitrage, and it's not like the perfect solution, but you can save quite a bit by just using a bit of finance strategies. So yeah, just things to consider. I've been getting a lot of questions, especially the last 48 hours around, mortgage deferrals. So I don't know if you guys seen some of the news, but yes, all major banks and most non-bank lenders are letting you do mortgage deferrals for up to 6 months. In other parts of the world, I mean, at the more extreme side of things, I just saw today a Danish bank who will pay you money to get a mortgage. That's correct. It's minus 0.5% to get a mortgage. So they will pay you 0.5% to pull out a mortgage. Super insane. Not sure how sustainable that is, but yeah, things are moving in very interesting directions. So yeah, keep in touch with what's happening in the market, or follow my newsletter or YouTube channel. We talk a lot about that, and it's pretty crazy what's kind of happening. That's it on refinances. So any homeowners have questions on refinances or things to do if you own a home right now, given the current climate? Okay, sweet. Moving on. So guys, we've got a few slides left here, and then we're going to go over to Q&A. So owning a home, again, I talked about if you're about to own a home, you can lock in a rate today for up to 120 days, lender specific. And the thing is, rates are increasing now. They dipped to like super low 2 weeks ago. Now they're starting to increase because a lot of lenders are starting to realize that people are going to start losing their jobs. And when you lose your job, you're not going to be able to pay off your mortgage the right way. Of course, now there's the mortgage deferral program, but even then, banks are getting cold feet, so rates are going up. So again, now's a good time to get pre-approved, put in an application, and try to get a rate hold for up to 4 months. Right now, as far as home prices, an interesting topic. From what I've heard from our realtor partners, at least in Toronto, is that there's still a huge undersupply of properties. And then people now have access to cheap debt. So of course, they're probably more incentivized to lock in a house now, right? And that's leading to bidding wars. There's, I heard of a house just the other day in Parkdale, which is an okay neighborhood in Toronto. There was 22 offers on a place there, right? So it's getting a little crazy, especially in Toronto. I mean, I guess in Vancouver. Of course, the market's taking a bit of a dip, but in certain ways it's going up again, right? And same sort of thing. Cheap debt means more people are presumably looking to lock into a mortgage, right, or buy a place. Now, in the next coming months, something that's up for debate or up for you guys to think about is there's going to be people that, on the realtor side, I know Adele's on the call, and we've got a few other realtors. You guys can't really do open houses unless you're doing something like this. So if you have less open houses and less people are letting people view their place, and there's less people just buying houses, then that becomes an issue, right? And maybe here, actually, for the realtors on the call, if anybody wants to give a bit of an update on how COVID has affected, specifically the real estate market and prices, and where you think prices may go in the next few months, I'd love for someone to speak up and maybe introduce themselves and just give us maybe a quick kind of 2-minute update on where you see what's happening in the market. Okay, I think, Samreen, are you with us? Do you want to at all give some input?
Yeah, hi. Okay, my name is Samrina. Hey, okay. So basically, if I have had a property on the market, I just put one up yesterday, and I've had 3 showings booked for it. I also have a house in Milton. This one the open houses were really, really good up until 2 weeks ago.
Okay.
Last week, I had about 9 people come, which has dropped from 15, maybe like 14,
Wow.
15. So it has dropped. And then I have another house that I'm putting on the market tomorrow.
Okay.
That's in Milton, but with the coming soon sign, I've had at least 6 calls. So it's very confusing as to people are well. I also checked on MLS, and there is 30 properties that came on the market today in Milton.
Okay.
Sorry, 18 properties came on the market in Milton, and 30 properties sold. So
Right.
it is activity. It's not that it's complete.
Especially in the suburbs, by the sounds of it.
Yeah, I mean, Milton is now slowly becoming I don't know, part of the GTA, you can say. Like people from
It's
Milton.
trendy. I've been there. I've had some
Yeah.
friends there.
People
Yeah.
are more Mississauga into Milton and stuff. And even like the other house that I have on the market in Brampton, I put it on the market last night, literally at like 8 o'clock. And I've
Okay.
already had 3 showings. So I mean there is activity. People who've already sold in the bidding wars are now looking for homes too, right? So those
Sure.
people need homes. So I mean there is movement, but I don't know where it's gonna go. It might go up, might go down, might slow, might not. Who knows?
Yeah. It's always kind of tough. Hey, Adele, I know you just jumped back on. Did you want to give any comments on, yeah, properties, maybe specifically in the GTA or in more urban environments? What are your thoughts on the pricing? This is assuming Adele's mic works, which once it starts to work, we can go back to that. But yeah, that's great input. Thanks so much. I mean, I appreciate it. So yeah, there's just some, I guess, some input on property. I mean, again, as always, it's sort of unknown, but here's some things to consider that could very feasibly happen. So we'll move on here, I guess, to our last slide, and really just comes down to, yeah, people that are renters right now, and maybe they're like, all right, great information. I'll hold on to that, but I'm still maybe a year or two away. So I want to introduce Russell from Key Living, and I'd love to just have a quick introduction and tell us about Key Living, one of the more progressive tech companies in real estate. It is from Toronto originally, and one of the founders is from Vancouver, so very much connected to the people on this call. So yeah, Russell, why don't we jump in here?
Thanks very much for the intro, Paul, and
Yeah, you
thanks
bet.
for the presentation up until now.
100%.
So, as Paul mentioned, my name is Russell Kim. I work for a company called Key Living. We are based out of Toronto. And really what we're looking to do is we're looking to address the sort of growing access and affordability crisis that's plaguing real estate in not just Toronto, but really sort of all, as we like to refer to them, sort of tier one alpha cities, global cities, however you want to refer to them, be they, you know, Paris, New York, Vancouver, Toronto, all of these sort of equivalent scale cities are facing some of these. Oh, that's a cool photo. Sorry about that. All of these cities and all of the inhabitants of these cities are facing some similar issues with regard to access to real estate becoming more and more difficult. So obviously, this primarily is a seminar on mortgage information. I do not mean to say that this is a be-all, end-all solution. In fact, if you are in a position where you can qualify for a mortgage and you know you're going to be able to hold that property for about 7 years plus, 100% do not listen to a thing I'm about to tell you. Go speak with Paul, get that mortgage. You will come out better financially on the other end. But for a lot of people who are presently unable to actually break into the real estate market because be it they don't have that, you know, down payment to qualify for a mortgage, or they don't have a history. For example, we have a client who came from the Middle East. They have about $500,000 liquid capital. They have a downtown directorship job in Toronto, make good money, but they just don't have the relevant history in Canada to actually qualify for a mortgage they're looking for. So for a lot of people who are sort of presently precluded from actually benefiting from the real estate market for whatever reason, we're really looking to address that segment of the population and really make it possible for them to break into a chunk of real estate ownership. So you'll get that stake in the market where you can actually appreciate from some of those positive movements in the market, and also reduce your monthly payment compared to what you'd be making as if you were just a renter. So the way we do that, I'm going to be super quick to try and be respectful of everyone's time, but we raise billions of dollars of institutional capital from entities who have been previously precluded from investing in multi-residential as an asset class as it's currently structured. We then use that capital to go to developers before they have done any pre-sales, and we purchase their entire developments. So we strip out marketing and sales expenses, translating to a roughly 10 to 15% discount on the acquisition of the real estate. And then we develop all of these holdings into 21st century infrastructure. And then instead of selling title to the individual units comprising our portfolio, instead we create an asset-backed digital share, which we call keys, the value of which is tied to the underlying net asset value of the portfolio held by Key Living, and then allow your people such as yourselves or myself to purchase equity in these keys, allowing a fractional exposure to the real estate market in which Key Living is operative. And once you have a $25,000 threshold ownership of these keys, you can actually pledge that back to us against the market value of a unit in our portfolio to establish ownership and occupancy rights of that specific unit. So you're always going to be in a better financial situation than if you are renting. And if you are looking to get ownership, then we offer instant redemptions when you would like to leave. So you can really build up your equity in our model. And then once you've reached a threshold that you feel comfortable using as a down payment, if you'd like to pursue that avenue, you can simply redeem all your equity in keys, cash that out to dollars, and then speak with somebody like Paul and pursue that white picket fence American dream sort of vision. So my email address is at the bottom there, russell@keyliving.com. I realize this has been very brief, but I'm happy to get into Q&A if anyone has any questions as to how we make this work, what the model looks like once you're actually living in it. And Paul, once again, I'm going to be trying to be respectful of everyone's time here. So if anyone has any further questions after the Q&A, we're doing another sort of lunch and learn ourselves. That'll be on March 26th. I'm happy to follow up with anyone at that time.
Love it. Boom. You got it.
Nice
Very
and quick.
cool. Yeah, I'm a big fan of the model. I think, I mean, just to turn into a narrative, right? If you paying rent somewhere and you move around a lot for work and, you know, you want to be in like, you know, like a nice spot. I kind of think of you as like, you know, WeWork, but for residential, which is not the best connotation with WeWork nowadays. But I mean, basically it's like, it's kind of like, you know, nice living. You've got this thing on the left where you can kind of plug into Uber and a bunch of value added vendors. And basically you're saying that people get market price rent or just below market price. So you kind of like in the club, and then you can of course move to different properties, right? Of San Francisco, Toronto. I know you're just starting here, but people can basically rent for a bit under market rate and then be an investor with the 25K and also have some mobility, right? If they're moving around to different cities. Is that kind of maybe a way to kind of wrap it up in a bow?
Exactly. So because you're not actually owning on title to the specific unit, you're owning in the portfolio. What that allows you to do actually is it allows you to move frictionlessly between any unit in the portfolio. So using myself as an example, I'm a tail end of a millennial guy. I'm currently single, no oops babies or anything that I currently know about. So if I were to be moving into a unit, I would probably be moving into like a 1-bedroom plus den, something like that fits my needs. But going forward, let's say, you know, I have said oops baby, or, you know, I meet a girl or something like that, my life circumstances change. Instead of having to, you know, sell my unit, find a new unit, pay land transfer tax, pay a bunch of, you know, realtors, not to dismiss any of the realtors in our audience here, but I can just seamlessly redeploy my equity within this pool to move to a, say, 2-bedroom plus den. And then what happens is my monthly payment would simply readjust to reflect the fact that my current ownership equity in keys would represent a smaller fraction of that more valuable unit compared to my 1-bedroom plus den. And as you mentioned, we are starting in Toronto. We have about $2.8 billion of real estate coming online over the next couple of years. Our plan is very much to be operative in sort of all tier 1 cities the world over. So once we do start making those more global moves, should you, for example, be living and working in Toronto, maybe you're a Google employee, and then you maybe get promoted because you're such a whiz kid to, you know, Silicon Valley. What you could do eventually is just redeploy your equity from your holdings in Toronto and move into a place in Silicon Valley, move into one of the available units there without actually having to do any buy-sell transaction. So to your point of comparing it to WeWork, which that was a much more honorable comparison in previous around this summer. We are very much looking for that same sort of model where no matter where you go in the world, if you go to a WeWork in London, in Amsterdam, in New York, or in Toronto, you're always going to get that same sort of level of quality of brand, you know, infrastructure and everything, while still having that ability to access their offerings in any community in which they are present.
I love it. So Q&A, guys. We've got a lot of things we've thrown out there. I've been speaking at a mile a minute here, but yeah, I love for people to ask any questions. Feel free to unmute yourself or ask it in the chat, whether it's around, of course, you know, primarily around mortgages. Maybe you've got something around real estate or even rentals. So with this, we're kind of done. If you want to sign off, you've got what you wanted. Awesome. Thanks for joining. I'll have the recording up later if you want to look at it and check out the Q&A. Other than that, it's totally open to questions. And you've, of course, got some of the contact information here to get in touch. Lots of processing, I know. Lots of stuff there. So yeah, I mean, I've been looking at the chat here. I had some questions around, do you have to pass a stress test with a refinance or a transfer to another lender? Typically, yes. You're still mandated to do that. So you've got to make sure your ratios are still in line. Samrina asked, and that was Nathan's question. Thank you for that, Nathan. April 5th, of course, was when the rate was going to change from the mortgage stress test level. I think it might have been the 6th, but basically they've moved that. It's no longer going to be the general average rate across Canada plus 2%. It's 5.04 until further notice, which again, you get a bit more affordability. But yeah, I mean, it's not a lot more right now. I think you're going to be mainly winning off the rate. Yeah, so those are some questions in the chat. I'll give us another 10 seconds for questions here. And if people are trying to get hungry, totally cool. Really grateful that you guys could join. And yeah, we will have our actual physical seminar with lots more updates as the dust settles in the near future. I've kind of penciled it in for around June. Hopefully we can do it sooner, but you'll definitely get some updates on that. And yeah, very grateful again for everyone for jumping on. We had a great attendance, actually, all else considering. So I appreciate that. Again, yeah, any more questions? I'll kind of have a nice awkward silence for maybe 10 seconds, and then after that, I'm gonna end the presentation. But any more questions? Okay. Look at that, Russell. We left people speechless. Well, that's good. Hopefully, it's a lot to process. Happy to share this deck and the recording. Everyone, yeah, thanks a lot for jumping in. I'm getting some comments here about the informative session. Thank you so much. And again, much more to come once we can do this in person. Hopefully, share some snacks. And I'm really passionate about the people in the Zoom room. I want you guys to collaborate and learn from each other, and that's gonna be a lot better once we can be over the social distancing. So again, with that, I'm gonna sign off. Happy evening. Stay healthy, everyone, and thanks again.
Thanks for putting this together, Paul, and stay healthy, everyone.
Yes, my pleasure. Thanks so much again, Russell, for jumping in here and giving people some more options. Thanks, everyone. Have a good night.